Welcome back to the deep dive. Today, we are dissecting one of the most fascinating and high-stakes gambles I think we've ever seen in the technology sector.
It's a big one.
Usually, when we look at a mega-cap tech stock, we're looking at a money printer. You know the drill. High margins, endless cash flow, a balance sheet that looks like a fortress.
That is the standard archetype for big tech, yes.
Yeah.
The compounders.
Exactly. But today, we're looking at a company that is effectively tearing up that entire playbook.
Setting it on fire, maybe.
Right. We are looking at Oracle Corporation, ticker symbol ORCL. The date is Friday, February 13th, 2026. And the numbers coming out of this company are, well, they present a paradox that's almost impossible to wrap your head around at first.
It's a case of cognitive dissonance in financial form. It really is.
On one side, you have a backlog of future business that is, and I'm not using this word lightly, staggering, over $500 billion.
$500 billion.
It looks like they won the lottery. It looks like they own the future of AI.
$523 billion in remaining performance obligations, or RPO. It's a number that just dwarfs the GDP of many mid-sized nations.
It's unbelievable. But then you flip the page. You stop looking at the promises and you start looking at the actual bank account.
The reality.
And you see a company that is just bleeding cash. They are burning money at a rate that would make a venture-backed startup sweat, all to build the concrete, steel, and silicon infrastructure needed to fulfill those promises.
It is the ultimate high-wire act. They are betting the entire firm on this transition from software to, well, heavy industry.
And that is our mission for today. We have a skeptical buy-side deep dive report in front of us. This isn't the glossy marketing deck from Investor Relations.
No, this is the forensic analysis, the stuff they don't want you to read too closely.
Our goal is to figure out, is Oracle a genius pivot that is going to dominate the next decade? Or is this a dangerous gamble that is going to crush shareholders under a mountain of debt?
And to answer that, we have to look past the headlines. We have to look at the plumbing of the business, the guts of it.
Okay, so let's map this out. We need to start with this identity crisis, this shift from being a software company to an infrastructure builder.
Right.
Then we need to get into the cash crunch, why their profit and their cash flow are telling two completely different stories.
That's the core of it.
Then we got to talk about the arena, the war against Amazon and Microsoft and Google, and finally, the verdict. Is it time to buy? Or is it time to just wait and see?
And I think we need to be very clear about the stakes here. This isn't just about a stock price moving up or down a few percent. This is about whether a legacy giant can fundamentally change the physics of its business model without completely imploding.
Let's start right there. The engine room.
Yeah.
You mentioned changing the physics of the business model.
Right.
For the last, 40 years, Oracle has been the absolute definition of a software compounder.
Absolutely.
Explain what that economic engine looked like and why this pivot is such a shock to the system.
Well, think about the Oracle of the last 3 decades. The database business. It was, frankly, one of the greatest business models ever invented.
It really was.
You write the code for the database once. That's your fixed cost. It's R&D. It's a sunk cost.
And then you just sell it 1,000,000 times.
You sell it 1,000,000 times, and the marginal cost of selling that next copy is basically zero.
Yeah.
But the real magic was the license support.
Ah, yes.
Once a company installed an Oracle database, it became the nervous system of their entire enterprise. You couldn't rip it out. It was just too risky, too embedded.
So every year, you paid Oracle a support fee.
Which was essentially a tax on corporate America. It was a high-margin annuity. In fiscal year 2025, that support generated $19.5 billion.
$19.5 billion. And the cost to service that revenue?
Minimal. It was almost pure profit. But, and here's the problem, it was flat. It wasn't growing.
Right. It's a melting ice cube, effectively. A very profitable, very slow-melting ice cube.
Exactly. And Wall Street hates flat. Wall Street wants growth. So Oracle looked at the landscape, they saw the AI revolution coming, and decided they weren't going to just sit there and manage a graceful decline.
They pivoted hard.
They pivoted to cloud services.
And this is where the numbers start to get just wild. The report says cloud services hit $24.5 billion in FY 2025. So the new engine is now bigger than the old engine.
In terms of revenue, yes, absolutely. The narrative has shifted. They are telling the world, we are an AI infrastructure company now. But here's where the physics, the whole model changes.
How so?
The old business was asset light. The new business is asset heavy.
Okay, explain that distinction for the listener who might not be a CPA. Why does asset heavy matter so much?
Because you are no longer selling code. You are selling capacity.
Yeah.
To sell AI services, you need data centers. massive ones.
Right. Buildings, servers.
You need gigawatts of power. You need cooling systems. And most importantly, you need hundreds of thousands of NVIDIA GPUs, which are incredibly expensive and hard to get.
So you're becoming a utility. You're becoming a construction company.
Precisely. In the software world, if you grow revenue by $10 billion, most of that drops to the bottom line because you didn't have to build a factory to do it.
Right.
In the infrastructure world, to grow revenue by $10 billion, you might have to spend $10 billion first just to build the capacity.
The capital intensity just explodes.
It's a completely different game.
Which brings us to this massive number that everyone is talking about, the RPO, remaining performance obligations, $523.3 billion as of November 2025.
Up from $97.3 billion just a year prior, a 5x increase. It's an astonishing jump.
Now, if I'm a casual investor, I see $500 billion backlog and I just smash the buy button.
Yep.
I'm thinking, they have $500 billion of sales locked in. But this technical report we're looking at, it calls this the RPO illusion. Why?
It's not that the money is fake. That's not the issue. It's that the timeline is completely misunderstood by the market. RPO is just due total value of signed contracts. It doesn't tell you when that money actually comes in. The report dug into the details, into the filings, and found that only about 10% of that $523 billion is expected to convert to revenue in the next 12 months.
Only 10%.
Rather.
So 90% of that $500 billion is just waiting in the wings.
It's deferred. It's scheduled for years 3, 4, 5, and even beyond. These are massive long-term capacity reservation contracts.
What does that mean, a capacity reservation contract?
A company comes to Oracle and says, we think we're going to need massive AI compute power in 2028 and 2029, so we will sign a contract today to reserve it.
Okay, so Oracle has a promise of money in 2029, but they have to build the data center today.
That is the crux of the entire problem. It creates a massive timing mismatch. To honor that contract and capture that future revenue, Oracle has to spend billions and billions of dollars right now to buy the land, pour the concrete, and secure the chips.
So the cash is going out the door today, but it's not coming back in for years.
Exactly. It's a build it and they might come scenario on a scale we haven't seen since, the telecom boom of the late 90s.
Wow, that's a scary comparison.
They are front-loading all the pain, the capex, the debt, the risk for a payoff that is spread out over a decade.
And that leads us directly into the financials. Because you can promise me the moon in 5 years, but if I run out of cash next month, I'm bankrupt.
Exactly.
We need to talk about the cash crunch.
This is where the story gets really ugly. If you just look at the income statement, the net income Oracle looks profitable, it looks fine.
But the income statement is an accounting construct, right?
It is. It includes non-cash items. It smooths things out. To see the truth, you have to look at the cash flow statement.
Cash never lies, as they say.
It really doesn't. Let's look at the capex, capital expenditures. This is the actual cash leaving the building to pay for assets.
Okay.
In the first half of fiscal year 2025, Oracle spent $6.3 billion. That's a lot, but for a company their size, it's manageable.
$6.3 billion. Got it.
Fast forward 1 year. First half of fiscal year 2026. That number surged to $20.5 billion.
Wait, say that again? From 6 to 20?
From 6.3 to 20.5 billion in 6 months.
That is violent. That is a vertical line on a chart.
It's a complete explosion. And if you zoom out to the trailing 12 months, they spent $35.5 billion on capex.
Okay, so $35.5 billion went out the door. How much cash did the business actually generate from its operations?
Operating cash flow was only $22.3 billion.
Stop there. I want to make sure everyone listening really grasps this. They brought in about $22 billion from selling their software and cloud services.
Correct.
But they spent over $35 billion building new stuff.
Correct. Which means their free cash flow, the money left over for shareholders, for dividends, for buybacks, was negative $13.2 billion.
They are burning $13 billion a year. This is the complete opposite of what Oracle has been for its entire life. They were a cannibal. They just bought back their own stock relentlessly because they had so much extra cash.
They were a self-funding machine. Now, they are a cash incinerator. And when you run a deficit of $13 billion a year, you can't just wish it away. You have to fund it somehow.
Debt.
Total borrowings as of November 2025 stood at roughly $108.1 billion.
$108 billion. That is a colossal amount of leverage for any company.
It is. And the credit rating agencies are definitely watching. The report notes that Moody's Ratings hasn't downgraded them to junk yet, but they have revised the outlook to negative.
And what was their reasoning?
The reason they cited is fascinating. It was counterparty risk.
Unpack that for us. What does Moody's mean by counterparty risk in this context?
It goes right back to that $500 billion backlog. Moody's is asking a simple question. Who are these customers? If Oracle is signing massive deals with Microsoft or Amazon or another giant, that's fine. Those companies will pay their bills. But if a big chunk of that backlog comes from AI startups, companies that are venture funded, also burning cash, and might not even exist in 3 years.
Then that backlog isn't solid. It's phantom revenue.
It could be.
If I build a data center for an AI startup and that startup goes bust because the AI bubble pops, I'm just left with an empty building and a mountain of debt.
Exactly. The debt is real. The revenue is conditional. And there is one more detail in the financials that I found particularly disturbing. It's what the report calls an earnings quality red flag.
I saw this. This was the Ampere deal.
That's the one. So in Q2 of 2026, Oracle reported net income that beat Wall Street expectations. The stock popped. Everyone cheered.
Okay.
But if you read the footnotes, and you always have to read the footnotes, that profit was boosted by a $2.7 billion non-operating gain.
So it had nothing to do with their actual business.
Nothing. They sold assets related to Ampere, a chip company they had invested in. They recognized a one-time gain from an asset sale.
That's financial engineering 101. You sell the furniture to pay the rent, and then you tell the landlord, look, I have income.
It completely masks the deterioration of the core business.
Yeah.
If you strip out that $2.7 billion one-time gain, the operating economics look much, much worse.
It feels desperate.
It suggests that the management team is trying to, dress up the windows while the house is on fire.
That is a classic signal for short sellers. When companies start relying on one-time gains to hit their EPS targets, it's usually because the main engine is sputtering.
Correct. So we have the massive cash burn, rising debt, and questionable earnings quality. But let's play devil's advocate for a minute.
Okay.
Maybe this is all worth it. Maybe they're building the future. If they capture the AI market, maybe $100 billion in debt is a small price to pay in the long run.
That brings us to Section 3, the arena. Because Oracle isn't the only one building data centers, they are walking onto a battlefield that is already occupied by absolute giants.
The hyperscalers. Amazon Web Services, Microsoft Azure, and Google Cloud.
What's the market share breakdown look like right now?
According to Synergy Research, those three hold about 63% of the global enterprise cloud infrastructure market. They are the oligopoly.
63% for just 3 companies? And Oracle.
Oracle is fighting for the single digits. Even with all this massive growth, their cloud run rate is around $32 billion. That sounds huge in isolation, but the total market is over $400 billion. They are, at best, a challenger.
Being a challenger is fine if you have a moat, some kind of a competitive advantage. We talked about the old database moat. It was impenetrable, but does that same moat exist in the AI cloud?
The report argues very strongly that it does not. And this is a really critical technical distinction. In the database world, the switching costs were incredibly high because of proprietary code and data structures. In the AI world, the workload is the model.
The large language model.
Right. And where does that model run? It runs on GPUs, usually NVIDIA H100s or their newer Blackwell chips. But here's the thing. Those chips are the same, whether you rent them from Oracle, from Amazon, or from a smaller player like CoreWeave.
So it's a commodity. The underlying hardware is identical.
It is rapidly becoming a commodity. Compute is becoming like electricity. You don't care which power plant generated your electricity, as long as the lights turn on and it's cheap.
So if Oracle tries to raise prices on me, I can just lift and shift my AI model over to Azure.
It is significantly easier to move an AI workload than it is to move a 30-year-old legacy database. So Oracle loses its pricing power.
Which means they have to compete on price.
They're competing on price.
Yeah.
And competing on price against Amazon, who is famous for operating with razor-thin margins to gain share, that is a very dangerous game.
It's a race to the bottom.
And it brings up what the report calls the overbuild risk. Oracle has $10 billion in unconditional purchase obligations.
Explain that term. Unconditional purchase obligations. What does that mean in plain English?
It means they have signed legally binding contracts with suppliers, likely hardware vendors like NVIDIA, and energy providers that say, We will pay you this money no matter what.
No matter what.
Even if nobody rents the servers, even if the economy crashes, even if AI turns out to be a fad, Oracle must pay those $10 billion.
So they have locked in their costs, but their revenue is totally variable and subject to intense competition.
That is the textbook definition of negative operating leverage in a downturn. If the AI bubble bursts or even just deflates a little, Oracle is left holding the bag. They've built the capacity for a party that might get canceled.
It really does feel like they're pushing all their chips into the center of the table, which makes you wonder, who is making these decisions? This feels like a founder-led all-or-nothing bet.
It is. And that's Section 4, Leadership and Governance. You cannot talk about Oracle without talking about Larry Ellison.
He's a legend, an absolute titan of the industry. There is no denying that. He built this company from nothing.
He owns roughly 40% of the stock. He's the chairman and the CTO. He is the strategic brain of the company. And frankly, he has a history of proving skeptics wrong. Do you remember the Sun Microsystems acquisition back in 2009?
I do. He bought a dying hardware company. Everyone, and I mean everyone, said, Larry has finally lost it. Hardware is a dinosaur.
And he turned it around. He integrated it. He optimized it. He absolutely proved them wrong. So there is a Larry premium built into this stock. People trust his instincts.
But the report suggests this time is different. Why?
Because the nature of the pivot is fundamentally different.
Yeah.
The Sun acquisition was about vertical integration, owning the entire stack from the software down to the server. It was a control play.
Okay.
This pivot, this is project finance. This is about managing construction logistics, energy trading, massive global supply chains, and complex debt markets.
It's a completely different skill set. It's not software engineering. It's civil engineering and investment banking rolled into one.
Exactly. And looking at the rest of the executive team, there are some concerns. As of September 2025, they appointed new co-CEOs, Clayton McGurk and Michael Cecilia. Safra Katz moved to executive vice chair.
Co-CEOs, I feel like business history is just littered with failed co-CEO experiments. SAP, BlackBerry, even Oracle itself had issues with this in the past, didn't they?
They did. The report specifically points to the Mark Hurd era. It creates what they call coordination risk. When you are navigating a transition, this perilous burning $13 billion a year in cash, you need a single hand on the wheel.
Right.
If the co-CEOs disagree on capital allocation or strategy or hiring, you get gridlock. And they can't afford gridlock right now.
And the compensation packages for them are eye-watering.
Option grants of $250 million and $100 million.
$250 million, $250 million for one executive.
It's massive. And the skeptics argue that this incentivizes the wrong behavior. It incentivizes them to pump the stock price in the short term, perhaps by hyping up that $500 billion RPO number rather than making the tough, disciplined decisions needed to survive this cash crunch.
It aligns them with the stock chart, not necessarily with the long-term health of the balance sheet.
Precisely. But there is one signal in this whole section that I think is the most damning. It wasn't about Larry, and it wasn't about the CEOs. It was about a deal that didn't happen.
The Blue Owl deal.
Yes. Reuters reported that Blue Owl Capital walked away from a $10 billion funding deal with Oracle.
Now, we need to pause here and explain who Blue Owl is, because most people haven't heard of them, but in the world of private credit, they are absolute titans.
Blue Owl isn't a venture capital firm looking for a 100x return on a risky moonshot. They are an alternative asset manager. They specialize in private credit and infrastructure deals.
So they fund boring things.
They look for boring, predictable, steady cash flows. They fund things that are supposed to be safe.
So if Oracle is building data centers, which are supposed to be the new utilities of the future, throwing off steady rent Blue Owl should be drooling over this deal.
It should be their bread and butter.
Yeah.
A $10 billion deal to fund infrastructure for a blue-chip tech giant. That should be the easiest yes in the world for them.
But they walked away.
They walked away. Now, we don't know the specific terms, but the very fact that they looked under the hood at the deal and said, no, the risk-reward here doesn't make sense, that tells you something is broken in the economics.
That is the smart money voting with their feet. If the infrastructure specialists don't trust your infrastructure economics, why should a regular retail investor?
That is the million-dollar question, or in this case, the $10 billion question. And it leads us to the final verdict.
Section 5, the verdict. The report calls itself a skeptical buy-side deep dive based on everything we've discussed, the cash burn, the debt, the competition, the failed funding. Where do they land on this?
The conclusion is blunt. Oracle is not investable today.
Not investable. That's a strong statement.
Very. The phrase they use, which I think is perfect, is that Oracle is a capital-intensive, counterparty-concentrated infrastructure build-out disguised as a software company.
And that's the key disconnect, isn't it? The market is valuing it like it's still the old high-engine software business with a PE of 30 plus.
Exactly. But the reality is it's becoming a low-margin, high-capex construction business.
You're paying a Porsche price for a dump truck.
A very leveraged dump truck.
So what are the failure scenarios here? How does this actually blow up?
The report lays out two main paths to failure. Scenario A is the demand shock. The AI hype cools off. We realize that maybe we don't need that many LLMs running all the time.
A bubble pops.
Right. Demand for GPUs drops off a cliff, and Oracle is left with massive, empty, very expensive data centers and $100 billion in debt to service.
That's the field of dreams nightmare. You built it and nobody came.
Scenario B is more subtle, but I think it's potentially more likely. They call it winning hurts.
Winning hurts. How can winning possibly be bad?
Suppose they win all the contracts, they get the customers, they fill up all data centers, everything looks great on the surface. But the cost of electricity keeps rising.
Which it is.
The cost of the next generation of chips stays high. And the competition from Amazon and Google forces them to keep lowering their prices to stay competitive.
So they generate huge amounts of revenue.
But zero profit, or even negative profit. They become a busy fool. They're moving massive amounts of money around, doing huge volume, but their return on invested capital is below their cost of capital. They are literally destroying value with every new contract they sign.
That is profitless prosperity, a classic value trap.
Exactly.
So given all that, is there any hope? Is there a world where we would actually change our minds and buy this stock? The report lists a path to redemption. What are the show me metrics? What do we need to see?
They list 4 very specific conditions, and they are strict. Number 1, proof that cloud growth leads to positive free cash flow. Not adjusted earnings, not EBITDA. Actual real cash in the bank. They want to see 4 to 6 consecutive quarters of positive cash generation.
Stop burning money. That's step 1. Makes sense.
Number 2, evidence that the RPO backlog is high quality. They want transparency. Who are these customers? Are they solvent blue-chip companies? They want to know that the $500 billion isn't just vaporware from a bunch of startups that could disappear tomorrow.
Okay.
Number 3, stabilization of debt. Just stop borrowing billions and billions of dollars every single quarter. Show that you can fund your operations internally.
And the last one.
And number 4,
Right.
proof of pricing power. Show that you can maintain or even grow your margins while competing head-to-head with AWS. Prove it's not just a race to the bottom.
So basically, stop promising the future and start delivering results in the present.
That's it, in a nutshell. Until those 4 conditions are met, the report advises staying on the sidelines and just watching.
This has been an incredibly illuminating look under the hood. It really highlights the danger of headline investing. You see $500 billion backlog and you think, growth. You don't see the $13 billion cash burn unless you actually dig in.
Context is absolutely everything in investing.
Let's wrap this up with a quick recap of the 3 big themes for you to take away. Theme 1, the pivot. Oracle is attempting a metamorphosis from a software compounder to a leveraged infrastructure builder. This fundamentally changes the risk profile of the stock. It is a different business now.
And needs to be valued as such.
Theme 2, the cash gap. Don't be fooled by that massive RPO number. A backlog is a promise, cash flow is reality, and right now the reality is a massive deficit.
A $13 billion deficit.
And theme 3, the smart money signal. When sophisticated private credit firms like Blue Owl walk away from funding your growth and the rating agencies start flagging counterparty risk, you need to be extremely cautious.
I couldn't have summarized it better.
So here is my final thought for you to chew on. Oracle is effectively betting the entire farm on AI. Larry Ellison is in his 80s now. He is making one last massive all-in push to ensure his legacy and keep his company relevant for the next 50 years.
It's a legacy play as much as it is a business play, I think.
And if they pull it off, if they somehow navigate this cash crunch, build out the infrastructure, and the AI demand holds up and is profitable, this will be studied in business schools forever. It will be the greatest second act in the history of technology.
It would be absolutely legendary, no question.
But if they don't, if the leverage crushes them, or if winning hurts and they just spin their wheels forever, it serves as a powerful reminder that in the world of heavy infrastructure, gravity always wins eventually.
Always check the cash flow statement.
Always check the cash flow statement. Thanks for listening to The Deep Dive. We'll see you next time.